Welcome out to another Trading Justice podcast. I'm joined with my brother Matt. This is Mark Justice from tackletrading.com. And we've got a lot to talk about. Markets have no end of stories to talk about. It's been a very, very busy week. We're going to break it all down for you. Naturally, we're going to have updates on the war, gold's price action, what's behind it. Going to talk to Fed. Hawkish hold last week. Jay Powell not exactly spreading sunshine, roses, and puppy dogs to the community. But we're going to break all that down. And then, of course, where are we in the ABC correction cycle right now? Busy podcast ahead. I'm really looking forward to the conversation with my brother. And the Trading Justice podcast is brought to you by Tackle Trading, an amazing community. And I can tell you firsthand, watching my brother guide our community through these times has been a pleasure and an honor to watch. He does such a great job breaking down the daily technicals, the daily stories, providing our community with the content, the resources, and the information to make accurate decisions in a really, really tough environment. Matt, so, I know you hate it when I compliment you, but you deservedly so. How you doing this morning, brother?
First of all, I'm doing great, but it's definitely a team effort. Really enjoy the Traders Lounge. And, I always tell the team, sun or rain in the market, Frank, myself, Bobby, you, and the coaches of Tackle Trading are going to navigate the environment. And so love having those conversations on a day in, day out basis in the Traders Lounge with the pro members of Tackle Trading. And, basically in the last 3 weeks, it's, speaking on the bull side of the equation, it's been a very risk-off environment, obviously, technically, and from a market environment. But you should see the conversations we have in the Traders Lounge every day. I think I end the day every single day with the same thing in the last 3 weeks. Team, I know everybody gets excited every now and then about an intraday bounce or, a nice little intraday reversal or staring down the barrel at a major support level that you have an opinion on. But as a bull, is it appropriate to do anything underneath the 90 EMA on the daily chart? And the answer is no, 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 no. And I have everybody in the team talk about that. And, it's just a gentle reminder that this entire conversation, wrapped up into geopolitical mess and central bank mess and uncertainty everywhere. That's one way to have the conversation. Another way to have it is from a technical perspective. And what I've been talking to the team is, regardless of what is out there, the technicals are going to tell the truth. And until we see a support build at a major level of support, and not just a support bounce, but a support build. And until we see that reclaim the 90 EMA and go through proper reversal analysis, we're going to be a little bit patient. It's going to be a cover call environment. And it's going to be a volatility playbook environment. And we help our community walk through those things and help them make those decisions every single day. Don't get me wrong. I'd rather navigate with the team on a bullish breakout, multiple time frame. Let's giddy up and go. Let's do all of that. But, you get these pullbacks about once, twice a year, to be perfectly blunt. And you get major market corrections about once every 2 years, and you get a major bear market once every 4 years, and you get a major market cycle once every 10 years. And so, these things are not abnormal. The market pullbacks, the corrections, the ABC cycles, they're not abnormal to the market. And whether you're a new trader or a veteran trader, new traders obviously need help in the understanding of it. Veteran traders need help in the application of it. And so wherever you're at in your own personal journey, I promise you, in that Traders Lounge and Tackle Trading in general, we're going to help you navigate and help you make those decisions.
Yeah, no, absolutely. Well said. I don't have a lot to add. I would love to add, but I think you summed it up really nicely. And Matt, you've been helping, those individuals on the podcast as well. We did a feature, a segment on the ABC cycle a few podcasts ago to help understand corrective market behavior, right? Because there's so many headlines, and we're going to dive into some of those headlines here in a minute.
If we had a conversation on every single headline and not minor headlines, I'm talking major headlines, this podcast would be 6 hours.
There are, there's
so
an
much
old
right now.
There's an old saying in the market, and I hope not to butcher it, but there's like weeks where years happen, right? Weeks where years happen.
The last
And
3 weeks feels like 3 decades.
and this is like, I mean, there was one Goldman trader, I think it was Bobby Mulvaney, where he was basically like, this has been the longest start to a year ever.
It definitely feels that because it's not the downward pressure in
No, it has
price that it's
zero to do with that.
starting. It's like that's
And
not.
let me give you an example, Matt. Let me give
Yeah,
you an
go ahead.
example. All right. So one of the things I do in my spare time is I ball games.
Yeah,
And
it's in the
Friday,
justice blood.
I,
Justices love
we love
sports and love being
sports.
around it.
We love sports. I love to, stay connected with community and the kids, and it makes me feel young. And I get paid a little bit of money to do some exercise and
You
stuff I
lose a
do.
little weight. Let's
And
not let.
I have lost a lot of
That's a
weight.
big one, buddy.
I
That's a big
have.
one.
And and so all day Friday and then most of Saturday, I was upping. And so when I talked to Matt, I was like, well, let's do the podcast. He's like, you're going to need a couple hours to catch up on news
Just a
just from the last
I was talking
24.
about Friday to Sunday. That's it.
Yeah, like just from
That's it.
you're going to need a couple hours to
Yeah.
prep to stay up just from the day and a half that you missed, right?
I'm willing to bet you didn't know President Trump gave a 48-hour ultimatum
I did
yesterday.
not until I started my prep,
Yeah.
because in between 11-year-olds pitching, really, really lame curveballs, I was not up to date on that. But that's the kind of cycle we're in. That's the
A pretty
kind of
good
cycle we're
curveball.
in. You know, there were a couple good ones actually. Kids these
I
days.
still don't believe in teaching 12-year-old curveball yet.
Well, they can throw some nasty ones.
I know, and I still don't believe it.
And so, like, one of the things, like, in this, like, insane news, because you and I mean, Goldman traders, people like this that live the market, it can be, I don't want to use the overwhelming, but, just saturating, like, on that. And so for like new
Well, the
traders,
market's got big shoulders, but
you know,
this one feels heavy right now, like just from an
oh,
overall
so
market.
heavy.
Yeah.
And so, this is one of the reasons that we emphasize technicals, not necessarily on the day. And this is what I love what you said a few minutes ago about on the intraday. Oh, we got an intraday signal. Great for a day trader, right? But as far as identifying the larger technical patterns that develop here, and I believe, like you believe, that the market has a very good chance at some point, not tomorrow, but in the coming weeks, of potentially, providing some kind of tradable pattern if it flows that way, right? But we'll see it on the chart. The chart will tell us. And so I wanted to just get an update, and then we're going to dive into the Fed right after, and then we'll talk about the war headlines ever evolving, assuming
Do you mind if we talk about the Fed first?
Okay, yeah, sure.
And the only reason is because in as I kind of break down the technicals, I'd like to talk about the response to the Fed technically as well.
All right. Well, let me give you a Fed
little bit
update.
of a curveball there, but
yeah, let me give you a Fed update from Wednesday, because we did have a lot of selling pressure after the Fed meeting, and it kind of, spurred that additional downward movement. All right, just to give you a high level stuff, this was one of those policy meetings where the Fed released their dot plot, released their summary of economic projections. And so we got a lot of data from the Fed. Nothing changed on the actual interest rate. That was totally baked in, like it was like 100% coming in. Miriam did dissent, which is, very typical, the Trump appointee. And then on the dot plot, basically they still priced in kind of a cut this year, although markets.
There was two before, and now there's one.
And they've reduced that.
I
Markets
don't
have
even think there's one. I really don't.
yeah.
I think there was
Market,
one
no.
after the Fed. I don't think the market expects any cuts this year. In fact,
No, and in fact, you've started to see after the Fed meeting pricing in a hike, not a cut. Like for the first time all year.
That hasn't been anywhere in the
in fact, not only not this year, but
it's been a while.
I can't remember the last time, right? It has been that long.
18 months. Like
it has been that long where there was even a smidge of the betting markets, the future odds, even hinting at the possibility of a hike. So if you want to know how markets
you have 12% of economists polled right now expect a hike next month.
Next month.
Right.
Now
you go down the road, you go all the way out to December of 26, for example, and the majority still kind of expect it right where it is currently right now, was about 12% with one hike throughout the year. But Mark, you look at this a couple weeks ago, there were two hikes through December with the expectation of September, October, or December. Two out of those 3 months, there's nothing. Like
No,
there's not a lot of expectation, and a lot of that is due to the uncertainty of the geopolitical situation. Powell talked about that, but yeah, like if you want to talk if you want to make it easy, like if you want to make all of the downward pressure in price post Fed and you want to make the environment a little easier, higher for longer typically has a negative reaction in the market.
it is that simple, right? And one of the
I
tailwinds
think
for
it's more
the
complicated than that,
yeah,
but
of course it is.
yeah.
One of the tailwinds for the market for the longest time has been the firm belief that the next move was a cut and
Mhm.
that there would be additional cuts. And I think this is very important to understand from a market, just understanding the basics of markets. For the longest time, the next move was expected to be a cut. And not only was it expected, there were multiple cuts priced in. That no longer is the case. And whenever you have that shift, right, that is almost entirely met in the short term with downward pressure. That has been Fed 101 understanding
Mhm.
since, I don't know, the dawn of the Fed, right?
I,
Like,
it goes back a very long time, but it's definitely been consistent ever since quantitative easing was started in 2009.
and so the interest rate cuts priced out. That's from like a nuts and bolts perspective,
Mhm.
understanding the markets, understanding how the Fed policy impacts markets. But then you have, from a sentiment standpoint, Jay Powell's press conference on Wednesday. And I thought Jay Powell was very, very honest with with the markets, and honest in the sense that he doesn't know what's coming next. I think he used the word uncertainty 100 million
Mhm.
times on Wednesday. Like that was the word du jour, for Wednesday, uncertainty. He was very, and we have a clip even when he was talking about the labor market, and it's just his general overtone. I don't want to say gloomy, but it was like it was not a man who was trying to convey to the market that he knows what's coming next on almost any front. And in this clip that you're about to play, he's talking about the labor market, something that the Fed hasn't spent a lot of time talking about. So I appreciated that. Let's talk, and we'll talk about the clip after.
But the thing that I think good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually, that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent, really, growth in the labor force, which, of course, we've never had.
I'll finish that, but why does it feel like that's what the economy needs, Jay Powell? Like, why do you think no job creation while people are retiring, getting laid off, and no job creation? Why do you feel like that's what the economy needs? It's almost like he's so close to connecting the dots to the AI scenario. It's like, you know what? We're getting zero job growth, despite the fact that we've had 200,000 average job growth for years now, but we've had zero in the last 6 to 12 months. And it just feels like, despite the fact that historically we needed 200,000 jobs created every single month just to maintain the balance of the labor market, but now we don't. We don't need 200,000 jobs created. We still got the people, Jay Powell. There's still the people there. But yeah, the economy doesn't need it to maintain the sustainability. Why is that the case, Jay Powell? Let's just connect those two dots. Why does the economy not need 200,000 jobs every single month? Despite layoffs and lack of hiring, why, Jay Powell? Please tell me why. Because we're still producing the same amount of goods. We're still producing the same amount of services. It's not like even in their dot plot or their SCP, they have a reduction towards a recession,
No, they
obviously.
were very optimistic in
So,
their
so,
growth.
so let's just please to help me out. Why, J Powell? Why does the economy not need those jobs to maintain efficiency? Hmm. So close, Mark. He's so close to connecting the AI dots there.
Yeah, or maybe he's not willing to talk about them openly for whatever reason. Because yeah,
That sounded like a man who was genuinely curious, to be honest with you. But let's finish
let's finish the
the
clip.
20 seconds.
In our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay, but I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So
Not comfortable.
but
Yeah, no, and that
I gave my thoughts. What's your thoughts
yeah,
on
no,
that?
and that last little where he's talking that, it's kind of like maybe some downside risk. It's not very comfortable. That was the Jay Powell all press conference.
I think he's talking to 70% of Americans. I don't feel real comfortable
I
with
don't
this
feel really
real
comfortable
job
with all of
creation
this,
now.
right?
Like,
And once again,
neither do we, Jay Powell. We don't feel comfortable
in
with
a
no job
different
creation either.
and in a different timeline where the war and oil was not a major story, and we'll get into the headlines here in a second. Jay Powell's take on jobs not being comfortable would getting cuts priced into the market, right? And so here you have a Fed chairman, and this is, when you try to analyze,
Like, based on that answer, I'd be like, ooh, is he going to do a 50 basis point cut next
is
month?
he going to do a 50 basis? He's like, this isn't comfortable.
He sounded downright concerned about labor. He hasn't so.
And so you walk out of the press conference, you walk out of the Fed meeting, and when you put the nuts and bolts of the price, the Fed futures actually kind of giving that little bit of hike, coupled with, oh yeah, and we got job problems, but even despite of that, we're going to even start to price in a hike.
Yeah.
That is not a great combination for risk on attitude, right? Risk on attitude. Not even, bringing the war into the equation, just from the understanding the Fed policy plus understanding the Fed futures funds, and then understanding, Powell's general tone and demeanor. So was not a great, Fed day for the bulls. And we've seen that in the charts ever since, Matt. We've seen that in the charts.
Before we get into the charts, just a couple thoughts for myself on the Fed. I think the Fed has kind of been painted into a corner a little bit here, both from their own doing and some of that from a geopolitical perspective. When you're talking about the concern on the labor market, you would be expecting interest rate cuts and the probability of interest rate cuts increasing. But the reality is to environments outside of the Fed's purview and outside of the Fed's responsibility, and Jay Powell talked about this during the press conference as well, was tariff impact. You had a recent Supreme Court case that basically ruled against the Trump administration on tariffs, put the control back into the hands of Congress. We haven't seen a lot of change as of right now because the Trump administration has been able to get around that through, emergency tariff authorization through different sections that gives him up to 5-6 months to continue. So there's some uncertainty there right now on the tariff side of the equation, and Jay Powell certainly mentioned that about the uncertainty. And then the obviously the biggest one is the entire Iranian oil situation with the Straits of Hormuz and whether or not the U.S. is going to invade Karg Island. And, when was it yesterday? The president gave a 48-hour ultimatum regarding the potential of further escalation if Iran doesn't open up the straits. Iran responded with how you would expect Iran to respond, quite frankly. And so we're still in that kind of that environment of escalation, and waiting on some degree of de-escalation. But that environment has created uncertainty, and oil is currently at $100 a barrel. Brent crude oil and the spread between oil and Brent is increasing. So when you're looking at the labor side of the equation, I would be concerned if I was Jay Powell too on the labor side of the equation. It's good to see him being slightly concerned. I've been concerned for well over 12 to 18 months on the labor side. It's my opinion that AI is not only coming, it's here, and it's going to start ripping apart the labor market in certain industries. And so he keeps talking about this for the last year. Hey, we haven't seen any growth in private sector. Well, we've seen negative action in the public sector regarding jobs and overall labor. And so there's been concern there, in my opinion, for a long time. And what kind of held the labor market up was, in my estimation, this illusion that companies had simply just decided to not fire people to allow the natural progression of jobs to kind of go down and them just not replace it. And that's kind of what's been transpiring
And
for
that's
the
what
last
we've
year.
seen. I mean, between the unemployment claims, which we get weekly, that's exactly
Well,
what
now
we've seen
Jay
in the
Powell's
data.
trying to connect those dots, and he's a year behind on that conversation. And so he's got concern on labor, and he's got concern on the inflationary side. Dot plot showed elevated inflationary expectations. That's why you're seeing the response on the future Fed fund futures, expecting no cuts and maybe even a hike this year. I'd be a little surprised. I expect a prolonged pause. I got to be real. I wasn't too surprised by anything Jay Powell said on Wednesday. I was expecting two things. Number one, Jay Powell to be data driven and Jay Powell to rely on the fence setting of data driven analysis, which Jay Powell is the most comfortable person I've ever seen setting on a fence of data driven analysis. And so I'm certainly expecting him to paint both sides as a concern. And he certainly did that. The net result is higher for longer coming out of it. Higher for longer means higher interest rates for longer than the market anticipated. And the second thing I anticipated was Jay Powell to wear a purple tie,
I,
and
I always,
that was where my
this was a
expectations
darker
was.
tone of his purple tie,
He
though.
definitely went with the darker tone, but you still got to call it purple. And so, purple, data driven mechanics, paint me as not surprised in any capacity. But the one word that continually came to my mind as I was watching Jay Powell's press conference on Wednesday was stagflation. He said I'm paraphrasing. He didn't say quote, but he did suggest that this environment should not be used for the term stagflation, that word should be, held off to describe much more terrible situations. Um, Inflation is used whether it's 1% or whether inflation is 10%, Jay Powell. You still call it inflation at 1%, you still call it inflation at 10%. And so stagflation is when the economy cannot grow outside of the inflationary scenario. And right now, GDP and the inflationary expectations, GDP got contracted, inflation went up, inflation is expected to be higher than GDP.
That's stagflation.
Inflation will eat up all degree of growth. And when inflation eats up all degree of growth, that's stagflation. So whether Jay Powell wants to admit it or not, that's kind of the environment we're in. And for 70% of Americans, it's far worse than that. And so I'm going to continue to use that word because that's the word you use to describe the current economic environment. And so whether Jay Powell wants to use it or not, it's the appropriate word. And so we're staring down the barrel at probably a bigger risk to stagflation than we've had since the 1970s currently. And until there's resolution on the Straits of Hormuz and the Iranian war, this is going to be a growing concern, not a deterioration of that. So
Yeah.
um,
And,
he was
and,
certainly concerned on both sides of the ledger, though.
yeah, and we'll talk about the war and war updates here in a second when we talk oil. But I do want to come back to the ABC cycle. We've seen downward price to end the week ever since the Fed meet. Headlines in the war have been all over the place. We'll talk about them here in a second. But just from a technical perspective, you started this journey on the ABC cycle, I think 3 weeks ago, discussing it. Where are we today in from the technical perspective on that?
We're what I would describe as we're actually fairly close to the conclusion of C in the short term side of the equation, and ultimately the equation. And I wrote about this in the newsletter, and basically what I've been doing in the newsletter the last 3 weeks is kind of put it on the radar of our community. ABC market correction 3 weeks ago, and then the last 2 weeks have been an update of where we are in that condition. And obviously, I go through a lot of detail in that assessment, but the simple reality, I kind of feel like 6,500 is that Goldilocks market correction number. It's the potential average yield in C. If you don't know what that means, I got a great class called Master Trader. Come join me. I'll teach you all about it. And so I would say in general, we're closer to the end of the market correction, but the closer to the end of the market correction could lead to a reversal or continuation. And that's where the conversation shifts is to where is support and what patterns do you need to see at support. And so as you're already down about 300 to 350 points from the bearish retrace or bear flag in B, that would put you to some degree of conclusion in C. And so 6,500 is a really, really, really important number for the market. That number's right where the 50 weekly is as well. And so it's step one is to identify support. Step two is to see a support build. Step three is waiting on pattern development. And so we're still in the patience is in play here. We're still in volatility playbook, and until we see a reversal here, we're going to continue to navigate it in that capacity. But I would say we're closer to a conclusion of the short-term ABC cycle today than we were last week and we were the week before. I know it doesn't feel that way on the chart because C is a
Well,
C.
I think you said it best. It feels heavy. Like every day feels heavy.
It does. It
It just
does.
feels
It
heavy.
does. And the market needs to get alleviated from that heaviness. And we need to see some positive reactions to some positive developments. We need to see de-escalation. I'm not sure Scott Besson expects de-escalation early this week. So yeah, it does feel heavy. But Mark, there's two different versions of the ABC cycle that we got to figure out. There's the one that ends in market corrections, and there's the one that ends in bear markets. And so it's kind of complicated technically. That's why you want to join us in the lounge as we break it down every single day. But in the short term analysis, I see this as the conclusion of C. In the longer term analysis, this could just be the starting point of A. And so I'm very open minded to seeing what patterns develop at these key levels of support because it's not support that tells you the conclusion of something. It's the support build and the patterns that develop at that support level that tells you the probability of something. And so we're still concerned about markets moving to the downside here. I still expect volatility. I would expect still further selling pressure here. I've said that every day since the
Here's
Fed.
the
Expect
events.
more selling
Yeah.
pressure, expect more selling pressure. And so I do expect more selling pressure, but at the end of the day, whether it's 6,500 or whether it's 6,170 by 6,200, I think this is the technical story is pretty well understood right now. The fundamental economic story, much more difficult than the technical story. The technical story is identify levels, wait on patterns to develop at those key levels. And one of those levels is 6,500. The other level is 62 to 6,170. And so I'm very open-minded to reversal analysis that happens at those levels. But without reversal analysis, um, it's more concern. And so number one, support hold. Number two, patterns develop. And as those patterns develop, usually you reclaim the 9 EMA and you start showing a little bit of some bull horns. But and I'll say it here, and I said it every day in the lounge this week. If the market cannot get above the 9 EMA on the daily chart, this is still a bear on bear momentum condition. And so even in alleviation moments, those are bear moves.
Which we've had several times.
We have, but those alleviations brought it up into the 9 EMA. Those alleviations brought it up into the 9 EMA. 9 EMA held, further depreciation of price. If you can't, and you got to ask yourself this question, if you can't even get above the 9 EMA, what are we talking about all this bullishness for? It's about preparation. Right? It's about preparation and understanding what you need to see so that when it starts to develop, you're ready to take action. And the mistake I think a lot of people have here is they try to get early here.
Yeah.
They try to get early and it just down, 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 down. Let me get early, down, 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 down. Let me get early, down, 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 down. And ultimately they get very frustrated. They quit. I've seen on Twitter a lot in the last 2 weeks. Hey, everybody tells me to keep the powder dry. I've been buying every single dip for the last 3 weeks. Well, has the technical suggested buy the dip yet? Buy the dip isn't trying to capture the low of a big red candle. That's a day trade. That's all that is. And we love those intraday reversals on the day trading side, but that's not a pickup zone from anything outside of that yet. And so it's a matter of understanding what you need to see to start seeing the alleviation. Support builds, number one, pattern development, number two, reclaiming the 9 EMA, number three. And in the back of your head, you also know as the market does those things, the volatility index will start going down and it will get under 20. And as the volatility index gets under 20, you have a much better situation moving into the future. And so I think the market's being very technically, I know it's market cycles and fear and extreme fear bids and all of that. But I do believe the market has been very technically, I don't want to say well behaved because it's been choppy, very choppy, but it's not like it hasn't tried to tell us things. And if we listen to the price action tells the bulls to still be cautious.
Yeah, no, it is as simple as that. It's going to be interesting if, because we've had three straight, the war, this will be entering the fourth week of the war. We've had three straight rallies to start the week into the 9 EMA. Be interesting to see if we get a fourth. Matt, you mentioned Scott Best. So let's talk, before we talk gold and silver, which I'm very curious about, let's talk crude oil. Just to give a recap, because the headlines naturally change, but I got a kick out of Scott Bessett being the one they threw out on the Sunday morning talk shows. They had been throwing out other individuals, Secretary of Energy Chris Wright. They obviously got our memo where we're like, this guy's not ready.
Get Chris Wright off that television. Bring in Scotty B.
And they did. They have brought in the heavy hitter. They brought in the heavy hitter. Scott Bessett, who was a regular coming out of Liberation Day lows about a year ago.
He honestly is one of the better messengers out of the Trump administration
because he knows how to speak to the market. He does a good job conveying the message. Let's see what old Bessett had to say.
I got to say something before we play the video. I watched this entire interview this morning on ABC, Meet the Press. Scott Bessett makes me laugh sometimes. I think I heard him say to, is it Kirsten Walker? Is it?
Yep.
Yeah. I heard him say probably 6 times, that's terrible framing. Just openly in an interview. That's terrible framing. I got a kick out of every single time. I just had to say that. But let's play the video and see what old Scotty B has to say here.
Considering sending troops into Iran, will the administration...
Every day, we are taking out their missiles, their missile systems, and the factories that build those missiles. And now the General Kane, Secretary Hegseth, are leading a campaign to destroy all the fortifications along the Straits of Hormuz.
Just to put a fine point on this, though, is the president in the process of winding down this war or escalating the conflict?
Again, they're not mutually exclusive. Sometimes you have to escalate to de-escalate.
Okay.
Woodrow Wilson at one point.
President Trump is considering sending troops into Iran. Will the administration...
Every day we are taking...
and that's the sound bite that is all over the place. Sometimes you have to escalate to de-escalate, right?
Yeah, what was your take on that?
I from such a complicated thing. Scotty B, right, was out there this morning giving the message that the administration wanted to give, right? They don't want to be pigeonholed into an exact time frame because I think those
or anything exactly, and I don't blame him on that.
And so like previously when Energy Secretary Wright or other people had been on the Sunday morning talk shows, it was a little more, hey, there's all of this great progress, and it's not that Scotty B didn't do that this morning because he was pointing to the the tactical accomplishments of the military, but it was very much on
we got to show some love to the United States military. They're the number one military in the world by a wide margin.
By a wide margin, right?
Reason. Yes, right. Like if the U.S. military gives orders to do something, that something gets done.
Yeah, but they don't want to be pigeonholed. And so what I felt like, Scotty B was out there doing this morning was, trying to speak to the voting bloc citizens saying, progress is being made. This eventually will be done. But also to communicate to markets and to those who are listening, i.e. Iran itself, right, who gets the clips of these shows as well, is that, there's a lot of cards still left to play in the deck potentially, right?
Well, doesn't that go on both sides of the ledger here? Like, yeah, the U.S. has more cards. The U.S. has tons of more cards. Does Iran have one card? Yeah, and it's the Strait. It's the Strait of Hormuz and economic pain. So I wouldn't say, like, I keep hearing this about who has all the cards and whatnot. It's like, it's war. Let's, like, both sides have cards, or it wouldn't be a war right now.
And so we're heading into the start of the week with Trump's ultimatum that he gave that if the straits are not opened within the 48 hours of his post.
And that was Saturday night was the 48 hours. So we're talking Monday night is kind of the deadline.
And so we're coming into that with that deadline hanging over. Iran's, basically saying we will hit all of the infrastructure in the region, not just U.S.
Energy,
but energy infrastructure throughout the region.
Well, let's be clear on what the ultimatum was. The ultimatum was the U.S. was going to take out energy infrastructure out of Iran is if Iran does not open up the straits. That was the 48-hour ultimatum. Iran responded with the same thing that they've said over the last 3, 4, 5 days. Send it.
Yeah. And so, we're heading in, and we have seen like very marginal progress on the straits in the sense that Iran is basically charging individuals to successfully move through, because a lot of the, and you
what are they charging them in?
I think, Chinese yuan, I believe.
Chinese yuan.
Yeah. Chinese yuan,
people are have to dump dollars to buy Chinese yuan to buy petrol out of Iran right now.
And so because a lot of the countries where that oil goes to are in Asia, right? Are in Asia. And so there is some, but make no mistake, between the shut-ins and between the Strait of Hormuz, who is not even close to being, fully, operational, there's a lot of economic pain that is being exerted. You mentioned Brent crude oil prices and the wide gap between Brent crude and the light sweet crude futures, price here in the United States.
Brent, there's always a spread between Brent and crude. It's usually $5-6. There's always a spread, but right now, like I've seen that spread get up to $50 this previous week. Oman was going like over 150 for Brent. And the situation between the light sweet West Texas oil we deal with here in the West versus the Brent crude is widening right now, given the fact that the U.S. there was an interesting debate in the lounge this week regarding if oil going up is good for the U.S. economy in comparison to other economies in the world. And my answer was no. Anytime you get oil above $90 and specifically above $100, that thing's going to wipe out consumers. The inflationary pressure is going to build to the point where it will spark a recession in the United States. But that also doesn't change the fact that countries that deal in Brent crude oil are having a significantly more difficult time right now because the U.S. is shielded to a certain extent. Number one, we are energy independent. We are the number one driller of all things oil in the world. We've been energy independent for a few years now, and it's very, 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 very vitally important that we continue to be energy independent moving into the future, especially in the age of AI 10, 15, 20 years ago, which I feel will have every country be more isolationist moving into the future. And so the energy independence is obviously an extreme positive for us in the U.S., and because we don't have to buy we don't buy any Iranian oil, but we do buy Saudi Arabian oil. We do buy natural gas from Qatar and UAE. And so as long as, and also, as long as the impact is mostly on the Brent side of the equation, the U.S. will be shielded to a certain extent, but very quickly.
Let's not forget S&P 500.
Oil is a global market commodity,
and S&P 500 companies do a very high percentage of their business
50%
overseas.
Yeah, 50%.
Right. And so even if the United States economy
makes you feel
relatively
like Russell 2000 a little bit, they only deal 30% of theirs still with companies outside the U.S.
But the earnings themselves, if large percentages of the global economy are getting wrecked, it's a relative better, but it's not good, and and you're going to see an earnings impact
I'm
on
gonna throw out a couple numbers. You tell me if you would be surprised if crude oil, not Brent, but if crude oil hits these numbers. Okay, obviously Besson is clearly anticipating some escalation. Would you agree?
Yeah, I don't know how you walk away of the Sunday morning talk shows without him telegraphing that there
A
will be
clear
some
ultimatum
escalation.
was made on Saturday night. Trump doesn't always wait for deadlines to get hit, by the way, but a clear ultimatum was made Sunday night. We've seen no walking of that back as of right now, and we're recording here on a Sunday, about 3 hours in front of the futures open is when we're recording this podcast, and the futures open is going to be very intense, ladies and gentlemen, very intense in my opinion. That's what I expect, volatility. But let's say we do see escalation, and Iran, every time we've escalated and basically Iran says, you escalate, we're going to do this. Usually it's target economic pain, energy infrastructure. We saw it big time last week with the LNG facility out of the UAE. Those scenes were apocalyptic, by the way. Iran's carried through with their threats. And so let's say, hypothetically, we strike the energy grid. Iran responds by hitting energy infrastructure, oil, natural gas, similar to what they did last week. Would 120 be shocking to you?
No,
130,
especially the nature of where they strike. Okay,
140,
no,
150,
you cannot put a cap on
160,
this. No,
170,
no,
200.
and that's where you start to get into there's a level, and anyone who says they know the exact level, there is a level where demand destruction kicks in, i.e. global economy doesn't fly because
global economy tanks, shuts down tanks, and we saw what the pandemic.
And so there is a cap at some point, and anyone who says they know where that cap is lying. They are making up numbers, but there is a cap where global demand.
Companies in Oman were paying more than 150 last week.
And so is that at 200? It would be a guess, but there is a feel at a certain level.
If another spike starts happening, what can the U.S. do to stop it? Hold on. Let me finish my question. They have already deregulated sanctions out of Russia. They've already deregulated sanctions out of Iran, which is crazy to me. Absolutely crazy. We're at war with Iran. Everything is about oil, and we're now allowing them to sell oil to China at the elevated price. Like, that's a little crazy to me. But they've already, we know they're trying to cap the impact of oil here. So they've already deregulated sanctions on Russia. They've already deregulated sanctions on Iran. They have already tapped Venezuela oil. They have already tapped the strategic reserve. They've already announced global initiatives to open up the strait. They've already announced global initiatives to increase oil supply. Saudi Arabia and OPEC has already discussed increasing supply. All of these things have already happened in the last 2 weeks. If escalation happens this week, how are they going to stop oil from going higher and higher? I think one of the reasons why we're seeing that widening gap in crude and Brent is because of all of these actions. Well, if you no longer, it's kind of like the Fed wasting the 6 bullets in their 6-shooter in front of the pandemic, right? When the pandemic you had no ammunition to go through. You couldn't stop anything. You had to increase money supply at a historic rate. So what can the powers that be do to stop the impact of crude oil if we see escalation, which is, as of right now, undeniable unless variables change? I mean, we got 24 more hours in the ultimatum, but what could they do? I'm having a hard time seeing it.
There's very limited cards they can do that aren't
they've already played them.
Yeah,
and so this is a big game of chicken, Mark. This is a game of chicken with the entire world economy between Iran, who seems to be very, very, very unwilling to come off their edge, And the Trump administration can't. Like at this point, they can't walk away from it. So we're staring down the barrel at massive escalation that may not have the ability to stop the impact of crude oil. That worries me going into this week, Mark.
Yeah, no, I mean, how the headlines break are going to have a massive impact on, just about every asset class there is out there.
Yeah.
That's just the reality we're in. That's just the reality that we're in. And we've seen, that as you pull up the gold chart, we see that, that volatility, striking areas of the market, that are, precious, to the pun intended here. Matt, what's going on with gold? What's going on with gold?
It's honestly the number one question I've gotten this week is because I think a lot of people are well positioned, at least in the tackle trading community. I think a lot of people are well positioned for the volatility in the stock market. This gold volatility kind of came, I don't want to say it came out of nowhere. We did have a major support violation this week, and that's what I think we got to start with. Two dojis to start the week, kissing off the 50-period moving average. That also was the 9 EMA that the market was trying to stop. Once you got underneath that, pocket filled. Technically, that's very understandable given the fact that pockets on the weekly chart have a tendency to fill. And I was talking to the team on Monday and Tuesday and basically said, I said, guys, listen, the simple reality is technically there is nothing underneath the low point here. There is nothing until we start working into 4550 to 4600. There's just nothing there. And so technically I wasn't too shocked at the fill on the weekly chart, although the speed of it was very aggressive. And so even though I felt like we had a good conversation on Monday and Tuesday about kind of the potential going into the Fed, I still think the volatility kind of shocked a little bit. And so it was definitely the number one question I got throughout the week, because a lot of people at Tackle are unlike the market. Their Tackle has a lot of long-term analysis on gold, we'll say. Definitely a little gold bug there. And so, it's not shocking to see what's going on in gold and that being like the number one question. And so I just kind of feel like there's, and by the way, I feel like all of these are extremely short term, because when you think about it from an overall environment perspective, gold's going down the last 3 days in the face of escalation geopolitical war headlines. That's kind of surprising a little bit. Gold's going down in the face of, oh my goodness, inflation. I'm not surprised by that because that's higher for longer, but in the short term, that has a tendency to go down. So when you're looking at the causation of why, I think it's important to understand why right now. And I don't think there's one answer on that, by the way. And so I'm just going to go down 3 reasons why I feel like gold short term is getting hammered here, and why this will most likely produce a great longer term buying opportunity a little bit south from here. Number one, whenever we see what's going on in the markets, i.e. ABC cycle market correction, Mark, are you too surprised to see margin calls in the stock market when we see this type of volatility?
No, I am not.
And what typically happens on a stock market margin call?
And this is the correlation of what happens. People sell their winners.
They sell their winners. And has there been any bigger winner in the market in the last 3 years outside of, say, Nvidia, but than gold?
Yeah, no, winners get sold. Gold's been a huge winner. Yes.
Yeah. So I think number one, we are seeing a little bit of margin calls to pay down a little bit of that negative margin call situation. Number two, there's something very interesting happening with those Middle Eastern countries right now. Those Middle Eastern countries love gold, Mark. Don't they? Does Saudi Arabia like gold?
Yes, they do.
Does Qatar like gold?
Yes.
UAE?
Yep.
Oman?
They're huge commodity countries.
Yeah, they love gold. Okay. Well, they're kind of being forced into a defensive war. Would you agree?
Oh, absolutely.
Okay.
And pretty pissed off about it too.
Very upset, both with us, but
mostly with Iran.
Kind of turning their anger collectively to Iran. Would you agree?
There's been multiple reports that many of these countries...
Saudi Arabia is almost ready to start offensive actions.
Yes.
And don't get me wrong, like I hate what's going on right now, but in terms of like the whole impact to the market. But when you look at Iran's strategic response, it makes sense to the Straits of Hormuz makes sense. If I'm Iran, I'm targeting the Straits of Hormuz. I'm not targeting my neighbors. Like I've felt like that is crazy from day one because yeah, short term it gets the impact you're seeking for. Longer term, you're talking about an entire Middle Eastern that is going to be, think about this for a second, on the same side of a war with Israel. Think about that. Since 1948, think about that. Qatar, UAE, Saudi Arabia, all these Middle Eastern countries being targeted, Jordan, all these Middle Eastern countries being targeted by Iran are going to be on the same side of a military conflict as Israel. That's how bad, in my opinion, Iran's strategy to target their neighbors is because now they were mad at us at first. Now they're really, really mad at Iran. And I would be too. And so what you have now is these Middle Eastern countries in the Abraham Accords. And I look forward to Saudi Arabia joining the Abraham Accords at one point. But you have these Middle Eastern countries dumping gold to buy dollars, to buy military equipment from the United States of America. And so you have this short-term situation where, for example, I think there was like 30 billion in additional contracts announced last week. Well, they're dumping gold to acquire the dollars necessary to buy military equipment, a lot on the defensive side, interceptors, stuff like that. But I think that's the second thing that is happening a little bit is you have increased dollar demand due to the military action in the Middle East. And then the third reason is when you come and you look at the technical response following the central bank. And when you look at the technical response to the S&P 500 following the central bank, when you look at those technical responses post-Fed this week, you saw a very, very, very similar type situation. You saw the market sell off and continue to sell off throughout the entire 2.5 days post-Fed. Well, what did the market do? Broke support on Fed. On the initial reaction, you broke support. Well, what did the market do on Fed day? Initially, on that Fed response, you violated support and you saw it go down to the next level and you saw that continue. And so there's a philosophy, not a philosophy, but there's a mathematical impact after the Fed announces policy that has to be priced into the market. And it's the higher for longer. Higher for longer gets priced into the market. And once the market prices in where they think the nominal Fed interest rate is, they move on to the next conversation. And so higher for longer also got priced in. And so you got three things happening this week that were just very heavy on the gold side of the equation. Is this a longer term situation or is this a shorter term? My opinion is this is all short term mechanics. And I'm definitely looking for a support build. What's your thoughts here on gold?
Yeah, I mean, long term, we know the story for gold, right? And I think you did a great job of breaking down the short term, right? I mean, you break those support levels and then you couple with these other exacerbating factors that you identified, right? In modern markets, those pockets can fill very, very quickly, right? And so
Yeah.
you come down, you fill those pockets, you fill that open space, and we might not be done with it, right? This is why, we pay attention to technicals and reversal patterns. But gold has a long history after bouts of volatility of giving you a signal of, okay, damage is done. I don't want to use the word giddy up because, whenever you're facing volatility, you want to have the right mindset. But it is very technically well behaved on
Can I just give an example of that?
Oh, there's a lot in the history, so I'm interested in what you're pulling from.
In every single time we go through market crises, initially gold goes down the same way everything else does, right? It did in this prime meltdown. It did in the pandemic. In fact, the pandemic, there was never a bigger fear in the world from an economic perspective than during the pandemic when every economic system basically went to zero. And so basically in that environment, gold actually went down. It went from $1,700 an ounce down to $1,500 an ounce. Went down about 15%, Mark, in total.
Real quick.
Okay. Real quick. But you know what? It stabilized faster than the market did, which went down for 3 months and went down 36%. See, in times of real fear, everything has a beta of 1, everything has a correlation factor of 1. It's what separates after that. And so we're down a good about 20% right now from the tops, very similar to what we were down in the pandemic. I certainly feel we could close the gap down to the 200-day moving average at 4150, or even the 50 weekly moving average at 4K. So you got a 500-point pocket to major support. So you obviously have a little concern going into this week. But I don't feel like gold's going to. I feel like gold's going to bottom before the S&P 500 will, and that's only because it happens almost every time.
Yeah, that's just a good historical bet. Yeah. That's just a good historical bet. Man, like seriously, like I think earlier you said we could go for 6 hours. You could go for 6 hours on everything.
I could talk for 2 hours on the Iranian war just itself. I could talk for 45 minutes on the economic landscape. We could go for hours and hours on the technicals. Like, oh yeah, absolutely. But the reality is, you navigate these every single day. I think it's important to understand the environment. I think it's important to understand kind of what the market's focused on. And I hope this, conversation so far in the Skyline has helped our listeners of the Trading Justice podcast understand a little bit more what's going on out there. But you live it every single day, and that's what we do in the Traders Lounge. So if you're not part of that yet, just hit that link in the description, become a pro member of Tackle Trading, and join us in the Traders Lounge every single day.
Let's fire through. I want to finish off with a stock or drop, because one of the things that I'm doing, I'm like in this
get
market,
outside the macro and let's talk about the individual.
Because,
I'm okay with that.
One of the things, because this is what you do in crisis, this is what you do in bear markets, this is what you do in corrections, is you're like, okay, I might not be doing much today, right? Because I'm respecting volatility. I'm playing defense. That's just what you do when you don't know if power plants are going to get blown up, and then Saudi pipelines are going to get blown up in response. Yeah. Or, you're careful, right?
Iranian ballistic missiles came very close to 3 very important religious sites in Jerusalem yesterday, Mark. If that were to happen, you want to talk about the biggest escalation in the history of mankind? Have those religious sites get hit in Jerusalem. But see what would happen.
Yeah. So obviously it goes without saying that,
please, cooler heads prevail, at least on that.
So obviously it goes without saying everything in a stock it or drop it is dependent on pattern reversal, how you want to, all standard.
Is it worthy to be on the radar?
Is it worthy to be the radar? And so there are a few, companies that had news or information. And I want to start with Tesla, Matt, because one of the things that I've been following as far as companies, very, very closely, kind of on my short list, have been Tesla, who, has its own technical, where potentially break a support, level here, downward pressure. So obviously from a technical perspective, but Matt, I am absolutely fascinated with the continued pivot that Elon is making with Tesla, announcing the launch of their TerraFab AI chip manufacturing product. It is part of this, just massive shift they are doing in seemingly in, stock market terms overnight, from, whatever they were, EV company S to an AI robotics chip company, probably everything that touches the future, right? Touches the future. What's your take on Tesla right now as we head into the week? So from a long term, everything's long term.
Honestly, I actually really like their decision to shift to robotics. I think it's a winning strategy in the long term, but in the short term, it's a tough start for the year, especially for those Max 7 components. Like, they have not led a damn thing this year. Also, Tesla, talk about the 9 EMA. Once again, you want to talk long term, if you can't reclaim the 9 EMA on the weekly chart, what are we talking long term for? You talk about the short term, they had a chance to reclaim that 9 EMA. They had really good development right around the 200-day moving average, actually tested up above that pivot point for 412 one time over the last week and a half. could not hold a bid in any capacity, violated major support level. You got to drop it. If you're a longer term investor, this is obviously a covered call environment, even a protected put option environment. But that is much more to me is the concern on the technical side of the equation than the fundamental side. This is a nasty pocket this is a nasty support level you broke on Tesla, entering into a filthy pocket on the weekly chart. Monthly chart feels like 350 here. And so 350 could be a conversation. But no, as of right this very second, it's got to go through reversal analysis, and that's weeks at best, in my opinion, away from now. So it's a drop it for me.
Next, I want to talk about NVIDIA. I think they got permission from the Chinese government to sell their H200 chips. Bernstein was also out with a note that basically said NVIDIA's free from a valuation perspective. I'm being glib and paraphrasing, but they were saying valuation's pretty cheap,
Bernstein said that?
Yeah.
Bernstein's right. I did a detailed assessment in the Tackle 25 mastermind group on all fundamental concepts out of the Tackle 25 this year so far. Tackle 25 has certainly outproduced what's happening in the general market, and fundamentally, I was expecting a few stocks to be horrific. I was pleasantly surprised on valuation. It actually contracted. Growth metrics have contracted a little bit as well, but valuation is down a little bit. And so specifically on NVIDIA, like valuation is down to, I want to say the PE ratios in the mid, I don't want to just make up numbers here. I did look at these earlier last week, but I want to be very clear on NVIDIA's fundamental side of the equation. So let's take a look at NVIDIA's fundamentals here. P ratio is 35. Forward P ratio is downright froggy cheap, like 15 forward P ratio for that revenue and EPS stream. PEG ratio at 0.40, sexy froggy. That's like one of those real froggy situations. Obviously, you have valuation concerns on all the price to sales book, price to free cash flow right now. That's a concern. But from a pure valuation perspective, yeah, and then NVIDIA's growth metrics could only be beaten by Micron's right now.
Yeah, and that was my next stock is Micron, who had earnings this week, and once again would be a massive story in the market if they didn't report after the Fed met and the war going on. But Micron, my goodness gracious, man!
I don't know if I said it, but I'm definitely in stock in NVIDIA.
Oh yeah, you did not.
It's a covered environment, but it's definitely a stock in.
Micron, what was your takeaway on the earnings? Stock going to drop a Micron?
Beyond impressed. I mean, truly beyond impressed. Micron came out with a report, and they've had a year of these types of reports, Mark, but at some point you expect slowing down to occur. The same way with NVIDIA. Over time, NVIDIA earnings got really, really accurate out of NVIDIA. We're not there on Micron. Micron beat by 39%. Revenue was up 200% year over year. And just an outlandishly impressive guidance. Guidance on the EPS side was increased by 59%. Guidance on the revenue by 38%. Those are both for Q3 26. And so, no, I was asked the day before in the Traders Lounge my expectations on Micron, and I said they're going to beat by a wide margin and they're going to go down. That's exactly what happened. So I'm not surprised by any capacity here. And honestly, I just felt like 8 straight days up kind of led to a profit taking down. That was all that was. Definitely a stock. This is probably it's not more important than NVIDIA's. It's not like the market doesn't care as much about Micron as NVIDIA and some of those other ones, but Micron is tier 1 AI name right there with NVIDIA, ASML, Taiwan Semiconductor, and Google. And I felt like they probably have one of the better, if not best, earnings stories in the market right now. The demand on memory right now is memory's basically gold.
Yeah, no, I've always looked at it as a commodity market, and my goodness gracious, what Micron is doing is
it's unreal.
It's unreal.
I think you put OLED NDK there a little bit too. Like SanDisk gets a lot of that same love. and SanDisk having a very similar price response, but on top of their breakout channel. And so, obviously Micron I got as a stock it, but I do have concerns at the top of the market. That's where most of my concerns are, is areas that are at the top of the market. I haven't seen things at the bottom of the market give into the volatility yet. Still a little bit neutral, still going through reversals. But for the most part, I would describe a lot of the technical damage is topside mechanics.
Yeah. I've close off with a couple top of the market type charts that have held up, really well. Both had earnings. Go with FedEx, who had earnings on Friday. Gave back a lot of the things, but relatively speaking, for cyclical based type stocks, FedEx has held up better than your average cyclical stocks. Couldn't hold the bid. Interesting candle to close the week right there at the 9 weekly. You read my mind. Stock gonna drop at FedEx, man. This was a tough one.
Yeah, it is a tough one. Top of the market problems on old FedEx, little gap up, sell down, suggest exhaustion, but Friday's sell off just kind of took on a story of its own right. It's battling the 9 EMA on the daily. It's battling the 9 EMA on the weekly. You got shifting volatility on the weekly. It's not an easy look there. I wouldn't say drop it, given the fact that they had a pretty decent earnings, 525 against 414. That's a nice beat against EPS. On the guidance side of the expectation, guidance was slightly elevated as well. So I don't think you can make a horrific fundamental argument here. We did gap up on earnings. So what I would suggest is, if it's a long-term investment, it's a covered environment. If you're at the top end of the market, it's a matter of just strategically, how do you want to navigate the top side mechanics here? On the short-term side of the equation, I would have a little concern here. But longer term, no, I think you got to stock it. You just got to cover it.
Now, and then final one, Five Below, also, discount retailer store. It's always interesting to me, and I really like, even if I'm not doing things in the short term, always making a note of relative strength. Always making note of relative strength in markets. One, because they can provide good trading opportunities, but then when volatility dies out, they tend to have the best
Market
patterns.
remembers those good fundamentals, doesn't it?
Yeah, and that is where I know it's a weighing market. I know it feels heavy, but just a little bit of homework you do, right? Those patterns when
It does feel heavy, but don't miss the bottom when the bottom gets put in. Don't get so frustrated with the volatility that you're like, oh, I'll just come back in a few months. Now, this thing could settle in over the next couple of weeks, could continue to go down, but you don't want to ever miss that bottoming opportunity, because the fundamental backdrop. Yeah, we can debate the Fed, we can debate labor, we can debate inflation and all that jazz, but you know what you can't debate right now? Earnings. Earnings has been absolutely fantastic. And I thought Micron was a clear winner, Blue Ribbon Award for the best report this week. I thought Five Below was a quiet second, honestly, and not just from the participation trophy award. They came out with an 8% beat. Revenue was up 24% year over year, and they increased guidance everywhere. And so a good little breakout on not just the daily chart. Like, when you look at this on a multiple time frame perspective, you're trying to dial in an all-time high breakout here. And so I definitely am watch listing Five Below here, waiting on secondary development.
Listen, I've enjoyed the podcast. It's been a good one. I always enjoy talking to you. Your insight in these times, and I said it at the first, I'll say it at the end. Your insight and your guiding force in our community has been. You want to pull up the debt clock?
Well, it's going to be part of my final thought, so you can.
Okay, well, I'm curious.
I was just going to sarcastically say congratulations to everybody. You worked very hard to get us to $39 trillion in debt. Just great job. Good job, everybody. Fantastic. We're up to $113,000 per citizen. We're up to 350. If you're a taxpayer in the United States, we are up to $357,000 in debt for every single tax-paying individual in America. That's fantastic. You know what? We're up to 124. You like big numbers? We're up to 124% of GDP. Our debt to GDP up to 124%. In 1960, that was 53%. Look at those weak ass numbers. 53, 34, 58. We're up to a whopping 124% of GDP. And you know what? We're not done. We got $22 trillion in M2 supply. Can't wait till that hits 30. And when M2 supply hits 30, I can't wait for the debt to hit 70. Just congratulations, everybody. Scotty B, good job. Janet Yellen, great job. Jay Powell, presidents galore, everybody, right side, left side, center of the aisle. If you're a politician in America over the last 25 years, you have certainly done your job to aid into this $39 trillion. Good job. Fantastic. We shouldn't fire any of you.
That segment was brought to you by the color gold.
That's why I think gold is a short-term downtrend right now. This is ridiculous. 39 trillion. By the way, 39 trillion, and we just asked for 200 billion more for the Iranian war. And now every Democrat in the world is saying, if you're going to give 200 billion there, we need to give 200 billion over here. Like, it's just insane. We've lost our collective mind. And I want to remind everybody, this only works as long as the dollar is the reserve of the world. Just keep that in mind, ladies and gentlemen. So
yeah, I look forward to that bottoming pattern in gold.
Yeah.
I do. But anything else, brother?
No, just congratulations. Just I thought, well deserved. We hit 39 trillion we went from 38 to 39 trillion in a faster manner, more effective, more efficient manner than we've ever done in the history of mankind. And you know what? We're going to hit 40 trillion faster than we hit 39 because we get better as we grow. As we get more knowledge about our debt, we get better at utilizing it. We're going to get to 42 faster than we got to 41. This is absolutely unreal, amazing. Good job, guys. Like, fantastic.
Listen, everyone,
and I truly hope everybody understood the sarcasm there.
Yes, and have a wonderful week, everyone. And check out that pro community. It's worth a gander. And have a great week, everyone.